Welcome back to the channel, ladies and gentlemen. I'm your host, Terry Julian, and folks, I've got a great lesson planned for you guys today. I'm going to do a follow-up to my second to last most recent video where I showed you how to take advantage of the upside move in the market by buying deep in the money options that deliver high probability of success for huge market gains. Well, in this video, I'm going to show you how to take advantage of the downside move in the market by buying very inexpensive puts using a bear put spread that puts you in position of generating some incredible gains with very, very low risk. You're going to learn a lot in this video, so sit back, relax, take some notes, and let's get started. So the name of my video is called How to Sell the Market for Less Than $150. And we're going to do that right now. Now let's jump right into it. The product I'm going to use is the SPY. The SPY is an ETF that has over 500 stocks in there that gives us a great snapshot of what the total market looks like and where it is in the buy sell chart. Now, folks, there are competitors to the SPY, right? There's VOO, there's some inverse and some other leverage products out there, but we're going to stick to the SPY. Why? Because it's very liquid, it's easy to get in and out of, and this is a popular ETF to do the kind of trade that we're doing right now. And plus, you can trade the SPY in practically any brokerage house or platform that you guys are using out there. Now, once we choose a product or ETF or stock, we need to understand what's been the general performance of the stock because that helps us define our thesis. Now, the SPY in the past week down 2%, past month just under 0.5% on the game, right? And last 3 months down just over 0.25%, and for the year to date it's up 4.25%. So as you can see here, short-term time frames showing declining strength in the stock, higher time frames still showing a bit of strength. Now, what's our investment thesis? There's a lot been going on. If you haven't been following the market, you really need to. But every time you go into a trade, you need to have a thesis written out, an idea that is the reason for why you're generating the trade. Here are my 3 points. Inflation rates have proven to remain consistently high, and current interest rates adjustments have not made an impact. So unless you've been hiding under a rock, the price of practically everything is going up. The Federal Reserve has been trying to counteract that, and they've moved interest rates higher, but they haven't really had an impact. Number 2, the Federal Reserve will continue to raise these interest rates, trying to control this rising inflation. And number 3, higher interest rates are going to slow economic growth by making it more expensive for consumers and businesses to borrow money. This can lead to lower earnings growth for companies, which will cause stock prices to decline. Point 4 I can make in there as well is that many of these high-flying stocks that don't make any money are pretty much ran by being able to borrow cheap money. Now, as the price of interest rates go higher, those firms cannot borrow the kind of capital that they're used to, and they've got to now scale back operations, and that means lower stock prices for them as well. So let's go ahead and get into this. We got this brother here sitting on the steps because he's really excited about the fact that he's about to make an incredibly winning trade. I need a big laptop like that. That's a huge screen. Let's go ahead and get started here. So putting this trade together, let's slow it down. Now, starting from A to Z. Now, in getting into any trade, we've got to determine the trend, we've got to confirm the trend, and we've got to identify a low-risk entry point. Now, folks, getting into the trade for you might be a completely different setup. This is my setup, and whatever you decide to do, make sure, again, you've got a step procedure that you follow for every single trade because it makes your life easier instead of doing what so many people are unfortunately doing out there, which is just guessing. All right, so let's go ahead and determine the trend. Now, what I do to determine the trend is I use the 50 and 100 moving average. Yes, yes, yes. Those of you guys will say, oh, you used to use the 25 and the 50. Well, that was before COVID and a lot of the false signals that we saw in that market. Now, with that being said, 50 and 100 does a better job of identifying, short, definitive, identifying strong buying pressure and strong selling pressure over a more significant period of time. So we rub out those false signals, the 50 and 100 moving crossing average, and we look for that on a daily chart. So in this case, for the SPY, it may not be there yet, but again, I want to put this video out now, right? And I hate to date my video. This is February 23rd, 2023. I hate to date it, but right now the SPY isn't beneath that. But again, for the case of just having this information out there, let's say it's beneath there, right? Is the stock below the 10-month moving average on the 1-month chart? Right? So now we're on the higher time frame. We looked at the daily, now we're on a higher time frame, 1-month chart under a 10 moving average. Why? Because we want to make sure that the short-term price action is indeed going down, that we are indeed seeing rising selling pressure, right? Answering these two questions allow us to determine the trend. And if it's indeed negative, then we've got some confirmation to start doing now. All right, so let's go ahead and confirm the trend. And we're going to confirm the trend using two of my favorite indicators. Again, for you, it might be something different. Has the RSI crossed below 50 RSI on the monthly chart? So again, identifying whether the selling pressure is real and the fact the stock is indeed losing strength. Two, let me introduce you to on balance volume. On balance volume is a great indicator to determine that we are, in fact, seeing lower and lower participation in the stock. Now, in any rising trend or rising stock, you should see on balance volume basically going straight up just like this, almost like somebody throwing up I hate to say this, but a Hail Hitler, with this arm. That's basically what it looks like when stock is going up. But when on balance volume is going lower, it looks like it's going in the other direction, like someone literally nose diving into a pool and not setting any new highs and not looking like it's going to set any new highs. That's basically what you're seeing is lower and lower participation in the stock. If you're seeing a beginning of that or what looks like an extension of that, you have now confirmed that trend that you identified in part one. All right. So now that we've got our two steps out of the way, we're going to identify a low risk entry. We use the Keltner channel to identify a low risk entry because the Keltner channel indicator does a really great job of identifying overbought and oversold signals. And in the chart here, as you can see here, we don't want to short anything well below the lower blue line, and we don't want to, in case of that previous video I did, we don't want to purchase anything on above the higher blue line above there, because more than likely the stock will sell off as people take profits on that overbought signal. Again, we're not the only people seeing these signals. People all over the world are using these commonly used points of price action to make sure they're getting great signals. So how are we going to play this? And we're going to play this using what's called a bear put spread. For those of you guys who don't know, a bear put spread basically consists of us buying one long put option at a higher strike price, and then we're going to sell one short put option at a lower price. Now, they're both going to have the same underlying stock, and they're both going to have the same expiration date. Now, this is a net debit spread. So basically, we're putting up all the capital in order for us to get a certain amount back when we win this trade. All right. And we're hoping that the stock is either going to stay level or decline in price. And that is going to be a higher probability because, again, we confirmed the trade 3 steps earlier. All right. So this is basically what it looks like. Right. So we know the x-axis and y-axis. Y-axis is vertical. X-axis is horizontal. Right. So we get maximum profit, right, when the stock stays beneath the x-axis, which is basically moving side to side or going down. If the stock gets vertical, that's when we start to lose money because it more than likely will go past our break even point, and that's what we don't want to happen, right? We don't want to go beyond the break even point. But again, we've got rules in place to make sure we don't ever take maximum loss. I've never ever taken maximum loss in the bear put spread because I don't let my trades get that bad, right? And I'm going to show you the rules that I use to make sure it doesn't get that bad if I pick the wrong thing, right? Which isn't often. All right. So let's go ahead and keep moving. All right. So we've got the option chain for SPY for today. And we know, and again, I hate to date my videos, but today is April 23rd, 2023. This is the in the money option chain for the SPY. The SPY is currently trading, I want to say, at $400.62, something like that. So we're looking at an in the money option chain. Here are puts, here are calls on the left side, our puts are on the right side. So this is deep in the money. And I'm looking at this chain right now, and I can tell you just off the top of my head, I like the 422 puts and that 420 selling that 422 and then buying selling the 420, excuse me, and then buying the 422. Both of them are incredibly liquid, and then both of them have relatively tight spreads. And that would be the beginning of our bear put spread. And folks, I'm going to put this together and show you why this trade makes sense right now. All right. So why does this trade make sense? Well, again, after a while, you're going to be able to identify just looking at the strike price whether or not this has very high intrinsic value. And it does. So we're going to take, again, that 422 strike price minus the current stock price or ETF price of SPY. And we've got an intrinsic value of $21.36. Well, what does that mean? That basically means that if I wanted to exercise that 422 option, right, and sell it into the market, I have $21.36 of intrinsic value over the current price of SPY, right? So I've got built-in value there on that $422 stock price, built-in value of $21.36. Now that we found intrinsic value, let's find time value. We're going to use time value by getting the options price of what we paid for 422, which is $24.38. We're going to subtract that by the intrinsic value, and then we're going to get a value of 3.02. That is your time value. We're going to take time value divided by the stock, right? The cost of the stock, the cost of the ETF. You're going to get a decimal number. We're going to multiply that by 100, and we're looking for a number less than 1%. In this case, it's going to be 0.7, right? What does this mean? For those of you guys who didn't watch the first video, that means that the SPY only has to decline by 0.7 in order for us to start making money on this option, right? Now, I know in my previous video, I believe I gave you an example of 3% or maybe even 2%. I can't remember right now. But again, if we were going in the other direction, a bullish, aggressive move in the market, then yeah, I'm going to be willing to be a little bit of a higher number because again, the market is bullish. We're headed in the right direction. Then I can be a little bit higher on this number. But when we're talking about a market that's selling off, right? We don't want to be too aggressive. We want to be as close to under 1% as possible because why? One reason is that when stocks sell off, they sell off very, very quickly and aggressively, and then it's over. And what happens is stocks tend to bounce once they sell off. So if you are deep in the money, right, and in this option, in this particular case, you need only 0.7% of a move. Let's say the stock declines 2% in one day. You've made quite a bit of capital on here, right? You've made quite a bit of capital on here. You can take your trade, you can take your profit right then and there and move on. Why? Because there's a very strong chance that the stock is going to bounce. and even rally for a little bit and eventually possibly come back down, particularly because those trends have broken lower. But again, we're traders, right? So we want to make sure we can, if we can get in there and make our money and move on to something else, let's do that. All right, so here's the trade as presented. We've bought the 422 puts, we've sold the 422 against it. And here's again just one option where we're putting up $153 of risk and we're making 25% on our money. All right, now the trade is list for 57 days, but you're not going to need 57 days to make your money to make some money in this trade. Why? Because I just showed you that we're only going to need 0.7% of a decline in this particular setup for us to start making some money. So if we get a 2% move lower, if we get a 3% move lower over the course of 3 to 4 days or a week, week and a half, we're going to make anywhere between 60 to 65% of our net gain here. So if you wake up one day, the stock is down 3%, right? And you're up, say you only took one option, which I hope you'd load up on more and get a little more aggressive. But again, trade your size now, trade your size. But say you only did take one option, right? You wake up one day and you're up $37, sell, take your profits and move on. I'm not going to hold the trade for $10. I'm never going to do that. If I was only going to make $47 and I've made nearly 90% of that, I'm gone. I'm going and I'm moving on to another opportunity. And I'm not going to sit in there for 57 days. It's not going to happen, right? You've got to be very smart about how you set up these trades. And folks, nobody's teaching our people how to do this, right? Nobody's teaching our people how to do this. Your big YouTubers that you love so much, they watch me. They steal from me and they go and sell you the same information for $500, $600 because they can't really trade. They don't really want to trade. They just want to make quick bucks selling you the dream of trading because they understand that less than 1% of people are actually going to use the information in their own lives, right? I want you guys to take this information and use it for yourself, right? And then teach someone else how to do it because this is how we break generation. This is how we grow generational wealth, right? The days of the putting money in the 401k, the days of hoping your 9 to 5 job is going to break you into the middle class, it's just not going to happen anymore. Right? It's just not going to happen for a lot of people anymore. You've got to become an active investor with your money. You've got to identify these trends, identify what the best ways to generate returns are, and then continue to put money to work. You've got to be active money maker. Let's keep it moving. Now, somebody out there is going to say, Sal, what about my chances of being exercised? Well, look, we've purchased 2 out of the money options. We're very far away from the current price action. In fact, if you take 420, which was with the option we sold, right, from where the current price action is, it's 5% or just under 5%. You should never allow price action to creep on you like that to where you're possibly getting exercised, right? If you are at risk of getting exercised on day one, first of all, you didn't buy out of the money, you didn't buy in the money deep enough, right? You didn't buy deep enough. And 2, you should be managing your trades at 30%. There is no way that I will allow myself to lose more than 25 to 30% on any trade, right? If I did not pick a correct entry point and I wake up in the morning and I'm down 26%, 27%, I'm closing that trade. There's no way I'm going to continue to sit there and watch my account lose money and risk a maximum loss for what? Because now the next trade has to be a guaranteed winner. And I've got to sit there and wait for the entire max gain in order to make what I've already lost back. So it's not worth it, guys, allowing sitting around and letting losses accumulate. How do we make money in trading? By making consistent gains, right? Letting our winners run, right? That makes sense, right? That makes sense. I mean, obviously, waiting for a couple dollars doesn't make sense. And two, minimizing our losses. Minimizing our losses. If we are down 20 to 30% on the trade route, it didn't work. I either didn't, my thesis wasn't strong enough, the sentiment in that particular product, ETF, or stock has changed, right? And now we're going in a different direction. Or I didn't get and take a very good entry point. That's another one. If you're losing on this particular situation here with a setup this good, your entry point was probably very weak. You either bought, in too high, or you bought in too low and the stock bounced against you. You really want, again, when you're setting up that Kelter channel, you really want to be in the middle if you can. Price action has sold off a little bit, that it hasn't sold off aggressively. Price action has bounced a little bit, but it's still been negative over a 50, 100-day time frame, 50, 100-day moving average. But it hasn't bounced so aggressively that we think that the trend is turned. All right, you get what I'm saying? I hope we're on the same page here. Folks, look, have you learned something today? Have you learned something today? Folks, if you have, please follow me at my Twitter page, Terry Julian Show, my Instagram, Terry Julian Show. I don't have much there now, but trust me, stuff is coming. Folks, I've got money to manage for myself and so many other people in my family. We're making a lot of money in this market, folks. A lot of money in this market. I've got about 9 uncles and aunts whose money I'm managing. And because they can't depend on Social Security because it's not keeping up with the price of the things they need. So I've got to generate returns for them in a monthly, quarterly basis that is going to keep them safe, secure, and well taken care of into their old age. So I don't have as much time as I used to, but folks, at the end of the day, there's going to be a lot of content that I'm going to put out on all those platforms. So if you can do me a favor and bless me by following me on those platforms, it really, really helped me. And if you haven't watched me before, click subscribe right now because there's a lot more of this great content to come. God bless you. Thank you for watching this in its entirety. So much more is to come. Tomorrow is another trading day. Trade well.
Black Box Stocks is an automated trading system that delivers real-time market alerts using a proprietary algorithm. Our system is composed of high-speed servers monitoring over 13,000 NASDAQ, NYSE, AMEX, and OTC stocks at the same time, analyzing each tick multiple times per second. This award-winning system levels the playing field by offering you technology that has too often been reserved for large financial firms, hedge funds, and the Wall Street elite. And when it comes to the results, let's just say that they are really, really good. Don't wait any longer. Visit blackboxtrader.org to start generating big gains right now.